Well, hello everyone. Welcome back again. Thank you for stopping by watching these videos. Always great for me to personally share these nuggets with you. And I'm always encouraged by the feedback that I get, comments or people sharing their stories on how they're implementing some of these ideas and how it's been beneficial and helpful on your own personal journey. All right, so today I want to talk about investment vehicles, right? Just because I know this is like one a lot of people have been waiting for, and judging by Womanpreneur, when I sent out that questionnaire, and lots of people were asking, well, how do I invest in the stock market? How do I invest in real estate? And I'm going to try to share all these ideas with you all in about 10 minutes. So brace up. It's going to be a lot of information, but I'd encourage you to watch the video over and over again. And of course, watch the previous videos as well. And the reason why for me it took me this long to actually get to this video, knowing that it's top of mind for a lot of different people, is I think it's more important to actually configure yourself internally for wealth creation versus actually talking about all the external things that you need to do for wealth creation. Because if you're not internally programmed and well set on the inside of you for this idea on creating wealth and creating financial security for yourself, then it really wouldn't matter what actions you take, because those would be wasted, because deep on the inside of you, you don't have the right mindset or the right framework to work with. Anyways, diving right into it, right? So as I think about investment, the first thing that comes to my mind is a return, right? And I like to define a return as the reward you get for taking risk. So return is the reward you get for taking risk. So if you take zero risk, no risk at all, you should expect zero, return, no returns at all. And the degree to which you begin to take more risk, right, which means that you might actually lose out. But for as long as you understand the risk that you're taking and you're able to manage the risk that you're taking, if you do come out successful in this endeavor, then you can expect the reward that you earn from this venture to actually be high, right? So that's where the whole phrase about, little risk, low return, high risk, high return, that's sort of where that idea came from, right? So as in talking about returns, I like to segment returns into three different categories. So you have your dead money, you have your safe money, and you have your healthy money. So what's dead money? Generally speaking, when you think about returns, you think about the government bonds as your risk-free rates. And the idea is that your government it's a credit-worthy entity. And you look at the bonds, which is government borrowing money from its citizens or borrowing money from people. And if you look at a 10-year treasury bond, for example, and I use 10 years because I want to anchor everyone to think about investments for the long term and not just like a short-term thing, right? So if you look at the 10-year US Treasury bond, for example, that's currently, at least as of September 4th, was at 0.7%. September 4th, 2020 was 0.7%. And I know a lot of people are watching, from Nigeria, at least registered from Nigeria for Womanpreneur. And if you look at the 10-year bond in Nigeria, it's somewhere around 9-10% thereabout. So that sort of gives you an indication of what your risk-free rates, and it's called risk-free because, generally your government shouldn't default because it can, quote unquote, just print money out to pay back its debt. So it's the risk-free rate. So that's like your low end of your dead money, right? Because there's no risk to that. And even at the upper end is probably you're looking at adding inflation to that as well, right? So the idea is in the US central bank is shooting for 2% on inflation. The treasury is about 0.72%. So any investment return that provides me 3% or less is dead, right? Because it's no risk, nothing's happening. If my money stays in there, I'm either losing money or it's not increasing in its purchasing power over the years, which is the whole point of investing the money, so that I have more that I can spend with just by putting a little aside here. All right, and if you think about that in Nigeria, I'm not sure what the inflation rate is in Nigeria, for example, but you take that inflation rate, add that to your 9% or 10%, which is the government risk-free rate. Now that tells you that any investment return that sort of gives you, any investment that gives you a return that's less than your risk-free rate plus inflation isn't really great. So that's an easy benchmark on how you think about dead money. Well, what everyone should be shooting for healthy money or safe money, right? So safe money is your risk-free rate plus a passive investment risk return, right? So what I mean by passive investment is that you're handing your money over to someone who's just going to give you the return for market participation, right? And what I mean by that is, if you invested in the stock market, on the average, what has the stock market returned, right? Or if you invested in the bond market, on the average, what has the bond market returned, whether it's corporate bonds. You can also segment the stock markets even further into like consumer goods, retail, healthcare, technology. At least at a basic level, what is the market return for investing in that? That's what you call your safe money return, right? And that's higher than your dead money return. It's just for participation, and that's it, right? You're not really doing much. Doesn't require a lot of your time. If it does require any of your time, you're just putting the money aside and it's generating a return for you, right? And then you have your healthy money return. And I like to think about entrepreneurship as fitting in this category as well, because you're actually shelving out money, you're taking a risk on a venture. And if it does hit, if you know what you're doing, you're managing the risk appropriately, and you understand what it is that you're doing, you should have some sort of an expectation of a return that is above market participation, because you're taking an active role in investing in here. And because of that activity, or because of that additional effort, the expectation is that you should yield an above average return. Now, one of the things that I have learned, and I want to encourage you on, is that many times people don't do well with individual stock picking. There's a lot of statistical information to show that, people don't do great. Not that you can't be successful doing it, but it just requires a lot of time. And it requires time and information. And if you do that, then you're actually moving away from, you're moving more into the healthy money space, because you're actually taking a bit more risk. So what I encourage people to do is, especially if you're just getting started out here, is look to your banks, right? Because that's like one way you can get information. So many banks today, I know First Bank in Nigeria, JP Morgan Chase here, Bank of America here, many banks today offer investment products, right? Or they have investment accounts that are accessible to everyone. And even here in the US, one of the things that I know that exists is, even with the private banks now, or with the commercial banks now, is that they're offering active advisory accounts or passive advisory accounts, and these are similar to these are supposed to compete with like the Wealthfront and things like that, Quest, etc. So there are all these types of third party as well, like apps as well, that you can put your money in, and that will help you make this decision around, they'll profile you on your risk appetite, your investment goals, etc., and they'll construct a portfolio for you. Right, you want to look into those. So look into your banks, Google something called Robo Advisors, that's ROBO Advisors on Google, and just try to find out what types of applications are out there that you can leverage, or talk to your bank and find out what investment accounts that they offer you that you can take advantage of, and actually start putting money aside. I encourage everyone to go on Google and look at what type of investment you're looking for, right? Certainly not dead money, but safe money. Maybe you have a day job, you have a steady income, and you just want to keep things steady, just keep things going that way. And as you do that, you can put some of your money inside of this, what's it called, in this safe money investment vehicles. Or if you have a little bit more time and you want to be more active in your investment, then maybe you can go into active investing and you get a healthy investment. But look at what those returns look like. Say if I put X amount of dollars aside on a monthly basis, what type of return can I expect to earn? And see how that money grows over the years. It would really blow your mind. And I really encourage everyone to do this, because it's helpful on a day-to-day basis to actually have a vision of how you can actually create financial wealth for yourself and for your family. So that's that on stocks, right? And then on real estate, a lot of people say, yeah, real estate is a good investment. I agree, real estate is a good investment. At a minimum, real estate tracks with inflation, right? At a basic minimum. But the way to really think about real estate as an investment is to think about income producing real estate. So always think about, if I'm buying a property, what type of returns can it give me? What type of income can it generate for me? And the way you think about that, or the way you approach that, is you say, how much in rent can I get from this property, right? Once you understand how much in rent can I get from this property, you're saying to yourself that what are the expenses that are associated with actually holding this property and owning this property. So your rental income net, your expenses is your net operating income from that building. You take that figure and you divide it into the cash that you actually have to put in to buy this property, and that is your investment return from holding that real estate. And you always have to think about it that way, right? So what you need to be doing right now is talking to people who are savvy in real estate and real estate investment professionals, and start finding out in the different neighborhoods around town that where, what are the types of properties that are generating rent? What type of rent can I expect from owning this type of property versus this other type of property, right? And based off of that, it might be a warehouse, it might be a single family home, or it might be a terrace home, or it might be a flat or a condo, whatever it is, but understand what the rents are like and what the costs are that are associated with owning this property, and figure out what your investment return is. A lot of people ask about land. They're like, well, I can just buy land, and land it's a good investment. And it's tricky, right? Because land sort of follows this, the return profile for land is really based on this idea of demand and supply, right? So if you buy land in an area where there isn't any development spreading into, and there really isn't any demand for the land, it wouldn't be helpful for you, just because you'd be out in the middle of nowhere and you may hold that parcel of land for decades without really seeing the type of return. At a minimum, it would grow with inflation, right? But if you're really looking for something that is bound to yield a return for you, you sort of want to watch how's development spreading. Where's the traffic coming from? Where are the jobs currently in the market? Where are the logistic routes in your current market? And find out, does that parcel of land actually cross any of these types of high traffic situations, whether it's for logistics, retail, or for residential, right? Or office use, right? And once you can find something where development seems to be spreading, or at least in the near future or in the midterm would be spreading towards that area, then you can actually make a play on land. And that's how you think about investing in land as a vehicle for real estate, right? So here's your to-do, right? Think about how much you have, how much you can put aside. Go find out about these different investment vehicles and how you can actually open an account so you can participate in these different markets. Talk to professionals so that you can actually start learning about how you can start buying income producing real estate. And based off of that, you can start making a decision as to how you can actually spread your money out so you can earn a return that is not dead money, which is just keeping your money under the bed or in your closet somewhere or in some bank account. Just that's dead money. But you want safe money. You actually want to take some risk. And if you're actually going out into entrepreneurship, which is a totally different ball game, you actually want to know what it is that you're doing, right? Understanding risk isn't the problem, but understanding the risk and being able to manage the risk is actually what you need to learn, and why you should be investing in yourself and in your business, or in your systems, in your processes, in the people for entrepreneurship. I know I've condensed a lot of different things that really should be like 2-3 hours in like a very short 10-15 minute video here. I know it's a lot. I'll provide you some additional information in the description section, and as well as with the notes that come with this video as well. But just wanted you to get started, right? So hopefully this helps. If you have more questions about what I've talked about, please don't hesitate to respond. Shoot me an email, throw a question out there in the comment section. These questions would be helpful for many different people. Would love to entertain those questions and answer those questions, because I know I covered so much in this video. Hope this helps. And I hope you're really getting a lot from these different videos that I'm sharing with you. All right, talk to you soon. Bye-bye.